CampbellRHarvey, Strategic Risk Management, Designing Portfolios and Managing Risk. Welcome to the world of Strategic Risk Management by CampbellRHarvey, where the complex science of investment strategy and risk management is distilled into practical wisdom. This summary introduces you to cutting-edge concepts like crisis alpha, trend following, and volatility targeting, all serving as tools to fortify your investment portfolio against market turbulence. From building diversified portfolios to managing drawdowns and understanding systematic versus discretionary fund approaches, this book is an essential guide for anyone keen on mastering the art of resilient investing. Whether you're a seasoned investor or a curious newcomer, you'll learn how adaptive strategies can bolster returns while minimizing risks, offering a lifeline through the inevitable ups and downs of financial markets. Dive in to unlock the secrets to crafting a crisis-resilient portfolio that thrives amidst uncertainty.
Crisis Alpha Unveiled. Crisis Alpha embodies a strategy focused on securing extra returns during market turbulence. By employing trend-following tactics, this approach adapts to market conditions, dynamically managing risk to protect gains. The essence lies in buying assets during rising markets and selling as they decline, capturing momentum across a spectrum of securities, from stocks to bonds and commodities. A critical inquiry arises: can these methods withstand rising government bond yields? Research champions bond futures trend following, attesting to its strength in safeguarding against extreme market downturns. Bonds often move counter to stocks, so maintaining bond market trends is crucial for preserving downside protection. This strategy's efficacy isn't limited to equities, it's equally potent for government bonds through diversified asset involvement. Solely focusing on non-equity markets could compromise optimal drawdown protection. Despite skepticism, diversified trend following has consistently provided crisis alpha for over 50 years. For investors aiming to shield their portfolios during upheavals, adaptive systems that prioritize risk reduction while sustaining returns are the way forward. This approach promises robust defensive capabilities and financial resilience amidst economic turmoil. Crisis-resilient investing. Crafting a portfolio that stands strong amidst market turbulence is a sought-after goal for investors. While absolute crisis immunity is an elusive ideal, there are numerous strategies to bolster your investments against severe downturns. Short-dated put options offer reliability but come at a price. Safe haven treasury bonds can yield favorable returns, though they may falter during crises. Meanwhile, gold and credit protection serve as moderately steadfast and cost-efficient alternatives. Adopting dynamic strategies proves beneficial, with options like momentum and currency shorting adapting well to fluctuating conditions. One-month S&P 500 put options can offer protection during crises but are often accompanied by steep costs. Achieving an entirely crisis-proof portfolio may not be feasible due to the inherent trade-off between security and affordability. However, creating a crisis-resilient one remains within reach. Passive option strategies might seem prohibitively expensive, yet historical trends indicate that futures, time series momentum, and long-short equity have consistently delivered admirable results. The objective is to secure positive returns during downturns while maintaining manageable expenses in stable periods. It's crucial for investors to evaluate potential drawdowns, which signify the extent of value decline in crisis-driven strategies. Balancing reliability and cost is key, leveraging a mix of passive hedges like long credit protection and dynamic strategies like time series momentum can effectively cushion against significant losses. Ultimately, absolute perfection in crisis proofing is unattainable. However, preparing with a diversified crisis alpha strategy, tailored to various market conditions, is a prudent course of action for investors looking to navigate uncertain landscapes wisely. Volatility targeting strategy. Navigating financial challenges doesn't always require new investment strategies. Instead, consider leveraging volatility targeting for crisis protection. This approach involves maintaining a consistent volatility level in your portfolio by adjusting leverage, adapting to volatility's persistent and inversely related nature to stock returns. By focusing on these volatility patterns, you can enhance risk-adjusted returns, minimize drastic price changes, and reduce significant drawdowns. The mechanism is simple yet effective: increase leverage when volatility drops and decrease it when volatility rises, aptly benefiting from the tendency of volatility to repeat recent patterns. Moreover, because stock volatility usually moves in opposite directions to returns, this strategy can increase market exposure after price declines, offering a buffer similar to momentum strategies. By actively managing volatility, the likelihood of severe price swings decreases, resulting in smaller drawdowns for balanced and risk-parity portfolios. This fosters overall portfolio stability, making your financial journey smoother by effectively counteracting volatility's unpredictable nature. Smarter portfolio strategies. Simply holding on to investments can lead to a portfolio losing its diversified edge, as your assets naturally drift. While rebalancing monthly might seem like a solution, it often falters during market slumps by selling high-performing assets and buying underperformers. To optimize, integrate rebalancing into longer-term strategy by aligning cash flows with asset adjustments and tracking stock-bond trends. Broaden your reach with international classes and capitalize on macro trends. Strategic rebalancing, when merged with momentum and wide-ranging diversification, not only manages risk but enhances portfolio resilience against downturns, transforming challenges into opportunities. Drawdown defense tactics. Successfully navigating the investment seas requires recognizing the human element within portfolio management. It's not a skill you retain passively like bike riding. Time, market shifts, or personal decisions might force you to reconsider who manages your investments. This decision-making process closely ties to understanding drawdowns, a measure of how much an investment's value has dipped from its highest to its lowest point. For instance, if your portfolio takes a 20% dip, your $10,000 investment shrinks to $8,000, showcasing how real potential losses can hit. By keeping a close eye on these drawdowns, you can craft strategies to mitigate losses. When your portfolio hits a significant dip, the critical question becomes: stick with your current manager or make a change? Consider the risks of keeping an underperformer versus the potential gains of retaining a high performer. Predicting drawdowns isn't straightforward, so setting reasonable boundaries based on your return expectations can vastly curb reckless risk-taking. Communication here is key: clearly set drawdown limits to encourage prudent risk management. As a backstop, implement automatic deallocation at specific thresholds to avoid rash, last-minute high-risk choices. Remember, two main missteps exist: keeping underperformers too long or letting talented managers go too soon. Weigh the cost of these errors carefully to refine your hiring and firing decisions. Total return rules provide a window into a manager's ongoing ability to deliver profits, while drawdown rules deal with sudden dips in performance. By embracing a time-adjusted drawdown approach, you create a framework for managing risk that assumes reaching certain drawdown levels becomes more probable over time. To command your portfolio prudently, align strategic investing, risk management, and ensure your manager maintains vigilance over evolving markets. Navigating hedge fund strategies. Dive into the contrasting worlds of systematic and discretionary hedge fund strategies, each with its unique strengths and challenges. Systematic funds employ rule-based, algorithmic strategies that excel in managing risks through data-driven techniques like diversification and high-frequency trading. These methods eliminate emotional bias and leverage vast data sets and backtesting. On the flip side, discretionary funds harness human expertise to capitalize on fundamental analysis, market sentiments, and qualitative risk assessments. Such approaches are particularly adept at handling short-term volatility and bespoke private equity deals. Despite their similar risk-adjusted returns historically, investors often question systematic strategies due to the differing inefficiencies they address. Equity long-short funds, for instance, are vulnerable to media events, while long-biased funds are sensitive to the outcomes of their significant holdings. Recognizing that each hedge fund blends diverse strategies and risks, it is crucial to adopt a balanced perspective. Embrace the harmony of systematic and discretionary methods, aligning your investment choices with your objectives, timeline, and risk tolerance. This synergy of approaches ensures a robust, adaptable investment framework tailored to ever-changing market dynamics. Crisis-proof investing. The COVID-19 pandemic served as a real-world stress test for the quantitative strategic risk management framework, proving its effectiveness during extreme market conditions. During this period, various investment strategies were assessed, revealing that trend-following and long-short equity strategies prioritizing quality and profitability successfully offered crisis alpha amid market turmoil. Volatility targeting strategies also demonstrated their worth, both as a risk management and investment tool, by significantly reducing equity and credit drawdowns compared to traditional approaches. Additionally, rebalancing methodologies faced scrutiny, with conditional strategies, postponing rebalancing during downturns, outperforming regular calendar-based approaches. The pandemic underscored the inadequacy of separating investment and risk management, highlighting the poor alignment of many conventional risk metrics. The way forward lies in an integrative risk management philosophy, combining advanced techniques like trend following, volatility targeting, and strategic rebalancing. These methods collectively offer a robust defense against drawdowns, even amidst unprecedented crises.
In conclusion, Strategic Risk Management by CampbellRHarvey provides a profound toolkit for navigating the volatile seas of financial markets. Through this journey, you've encountered transformative strategies like volatility targeting and strategic rebalancing, which collectively furnish a robust defense against market downturns. The real-world test during the COVID-19 pandemic underscores the efficacy of these strategies, proving that an integrated approach to risk and investment management can significantly cushion portfolios against severe drawdowns. The harmonious blend of systematic and discretionary strategies further enriches your investment playbook, ensuring flexibility and resilience. Embracing these insights, you'll be better equipped to manage risks, optimize returns, and achieve a balanced and crisis-resilient investment approach. Let this summary serve as a powerful resource to guide your financial decisions, safeguarding your investments in an unpredictable world.